Paul Dietrich, Wedbush Securities chief investment strategist. I know you love the fact that the market recovered, but you are extremely concerned about screaming valuations.
Well, basically, given everything that's happening in the world, the geopolitical problems, unemployment is flat, and everyone knows it's softening. Retail sales are down. I mean, we're going from a 15-year bull market cycle, which was up, and we're turning down into a more contracting cycle, and yet the stock market is overvalued at a record overvaluation that we've never seen in the history of the United States. If you use like the Buffett Indicator or even the Shiller-Cape price earnings ratios. So all of these things, and what's interesting is that institutional investors in hedge funds, professional investors, they're bringing down their equity percentages that they own, while retail, smaller Main Street investors are piling in. And I'm afraid that's not going to end well. They're coming in at the height of the market just as the business cycle is turning into a slowdown.
Warren Buffett, arguably the greatest investor of our era, has been a net seller of stocks over, well, on paper we know the past 4 quarters. He could be still selling right now. He has a huge pile of cash. He is simply waiting, like I like to say, like a lizard with the tongue ready to go out and get that juicy bug that he's waiting for. And he had said during his annual shareholder meeting, this is nothing what we saw during the post-tariff tiff that we saw April 3rd, 4th, 5th when the markets tanked. He said, 10%, 15%, okay, then we're talking, and that's when you come in to buy. So he's not ready. Do you see a sell-off of that magnitude coming?
Yes. I mean, he's got this great indicator, which he says is basically the best way to determine, and has been for 125 years. What he does is he takes total stock market capitalization in the United States, and he divides it by the gross domestic product.
Hold on, we've actually got the formula, which we already showed, but maybe we can pop it up because now you're walking us through it. Professor, go ahead.
And so what's happened is that a month or so ago, it reached its highest level of 204%. It's right now about 198%. It's still at a very high point. At the height of the dot-com bubble, right before it broke into recession, it was only at 150%.
Oh, wow. Okay.
It was higher, and it's so much higher than the Depression was back in the 20s and 30s. And he's been selling, as he's watched this climb, he's been selling for the last 2 years, and he's been honest about it. He said, look, I'm probably going to buy back Apple and all the stocks that I've sold. I'm just going to buy them back at a big discount, and I'll pocket that.
What are you advising your clients to buy if and when that happens?
First of all, I always think that it's prudent. Talk to your financial advisor, because there are tax considerations and everything like that. You have to talk to the professionals who are helping you manage your money. But as we're going from an expanding economy for 15 years to one that's contracting, you need to change your asset allocation a bit. You want to be fully diversified, but you want to have more bonds. You want to have more gold. My clients are 25% in gold, and you know, gold has been up 25% over the last year. And a lot of those institutional investors, with the dollar dropping, have been buying gold. Central banks are buying gold. I think this is a good hedge. And then, you know, there are utilities. And if you think back during the previous 2 recessions, the stocks that did the best were McDonald's, Costco, Walmart, those types of big box stores, dollar stores. And those, even if they go down, they're not going to go down as much as the rest of the market.
You worried at all about treasuries? I mean, we had a little treasury scare during the start of the Liberation Day tariffs, and we started to see sellers international sellers of U.S. government debt. Things have stabilized, certainly come back off those 4.5% yields for the 10-year.
It's going to continue. I mean, Japan is our biggest buyer or the biggest holder of U.S. Treasuries. And as they've been raising interest rates, the Japanese are having to sell, and then the Chinese are doing a lot of selling just because they don't like America.
We got 10 seconds. The Iran-Israel war, how front and center is that in investors' minds, or should it be? If people are watching and say, should I be scared? Does it really affect our equity market?
The big question is, if we go in and bomb, what will Iran do? All they have to do is send a missile into the Straits of Hormuz, and the insurance companies, they don't have to hit anything. The insurance companies will stop all those tankers. And I've been seeing analyst reports that talk about $125 to $200 a barrel if that happens.
That's a big if. That's a big if. Paul, good to see you.
Thank you, Liz.
Thanks for coming.